Welcome to the Note versus series. In this video, we'll be taking a note and putting it up against a rental, and we'll see what the differences are between the two and which one will come out on top. Now, the first thing we need to discuss is that this is the finance business. This is the paper side of real estate. Now, a stick and brick house is going to be the collateral we could take back if something should happen, or worst case scenario. But in this video, we're just going to concentrate on a note versus a rental. Now, one of the greatest things about notes is that you can sell the property with financing and bring in a higher price and a big down payment. So let's take a look at the two and see how they stack up. So, the first thing you're going to notice is that the market value is $120,000 for both the note and the rental property. When we're comparing two investments, we want to keep it fair for both to get a better answer. So we're going to take the same market value and stack them up against each other, so we have a fair assessment of the two. One of the first things you should notice on the note side is that it has a higher sales price. It's $130,000, and because we're in the note space, we can get a higher price point and a higher cash down payment. So under the note, you should see a sales price of $130,000 and a down payment of $15,000. So when we stack the two together, a rental property has a total investment of $120,000. But on our note side, we're able to charge a little bit more, and we're also getting a down payment. So we're only into this for $115,000. This will come into play a little bit further. But the biggest takeaway here is that you're selling a note for $130,000, and your total investment out of pocket is only $115,000. So let's move on to income. Notes pay about the same as rentals, but without the headaches of tenants, toilets, and aggravation that come along with it. Let's see what happens when we stack these against each other. The rental property is going to bring around $900 a month. Now we'll want to take out vacancies to $45 a month, which will adjust the gross income of the rental to $855. But on the note side, you'll see it's zero. We get the whole principal and interest payment at $819. So as of now, they're still around the same price point. But let's dig a bit further and see what expenses take a chunk out of the payment. Now, notes don't have big expenses like rentals. That's one of the biggest advantages notes have over them. The rental property has a property management firm that averages about 10% of the monthly income. So that's $90 right there. But then we have to include property taxes, insurance, HOA dues. Some rentals even include utilities, but that's not in this example because that's the renter's obligation mostly. But there is a maintenance fee that you should be setting aside for fixes that will occur. So once you add all these together, the total profit on the rental side is only going to be $360 a month. But our note is staying strong and avoids these expenses at $0 a month because all the expenses we just mentioned is the responsibility of the homeowner, and it's their job to pay for that. So the note holder still gets their $819 a month in profit. Remember, we're the bank, and people don't call the bank when something goes wrong. And one of the biggest secrets to true wealth is keeping what you earn. Thanks for watching.